$500 tax credit. That now means that $1,000 of tax is now $500. So when we're looking at tax planning and tax strategies, we're always looking for things like, can we take a tax credit for you? Is it just tax deductions? Sometimes you might have a little bit of both, but just keep in mind that we're trying to strategize to take advantage of as much of those tax credits as we can, because they're very valuable, as well as tax deductions. Next slide. All right, why keeping accurate records matters? Well, it is required by the IRS. Should you be one of those lucky people who gets pulled for an audit, you're gonna need to substantiate your financial data. And you do that by having good records. Keep receipts and invoices. And I would say keep detailed receipts, detailed invoices especially. Going back to the depreciation we talked about on the first slide, there's a election you can make on your tax return that I'm hoping most people are taking, where you can elect to basically expense any items that you purchase that are $2,500 and under. So normally certain things would need to be capitalized, like computer equipment, stuff like that. But if it's under that threshold, you can just expense it. The benefit to that is that you no longer have to track it. So the minute we have to capitalize something and depreciate it on a tax return, it means you're also having to probably do that on your books for GAAP. And that's just extra record keeping, extra tracking. At some point, your tax preparer is probably going to ask you, do you still have this? You're going to have to go look for it. It's so much cleaner and easier and efficient to be able to expense as much as possible. Not only that, it's beneficial, obviously, for your bottom line. In order to do that, having detailed invoices is really important. So you go to your computer, Best Buy or somebody, you buy a computer system, they give you a computer system, they put $5,000. Well, that needs to be capitalized. I can't, no two ways about it. From a tax perspective, I got to capitalize it. However, if I have a detailed invoice that says that computer system was, a $2,000, laptop, $1,000 printer, and all these other accessories, I now have a way to break that down and say, yeah, I can expense all that. I no longer have to deal with capitalizing it. So you get the full tax deduction right away, and you don't have to deal with tracking that stuff around. Other reasons why accurate records matter, obviously audit prep. It can keep your business compliant with other regulatory issues you may have to deal with. Certainly things like being able to track things for your personal property tax returns if you're in a PPT state. It can help with your budgeting. If you don't have good detail, you don't have good records, you really don't know what you spent your money on. You buy things on like a debit card or a credit card, and all you see is, your credit card detail in your QuickBooks file. That's not going to help you figure out what you spent your money on. So you really want to try and get as much, detail and accuracy as possible. It can help improve your cash flow, because once you know where your money is going, then you can sit there and say, okay, now I can make decisions better. And it improves your tax prep process. The more detail I can see as a tax preparer, the less questions I'm going to have to ask you for. And also, when I do ask questions, you're going to be able to say, oh, I got that. You're not going to be like scrambling trying to find it. You have it. Next slide, please. All right, so this is just a high level, what is a deductible business expense? Travel and meal expenses are deductible. However, meals are kept at a 50% deduction. So travel is 100%, meals are 50%. So you do need to separate them. I recommend keeping a separate account for meal and travel just to make it easier. That way we don't have to sort it out at the end of the year and try to figure out what's meal, what's travel. Entertainment, by the way, is not deductible. So if you take people on a fishing trip or a golf outing, that is maybe a business expense, but it's not a tax deductible expense. So we would need to have those at least identified so that we know to pull that out of your deductions. If that fishing trip included a meal, the meal would be deductible at 50%, but the cost of the fishing trip would not be deductible. Keep in mind also, if you have employees, expenses related to employee events like holiday parties, however, are 100% deductible. Again, good record keeping. Call that out. We can then put that into the 100% deductible bucket and give you that full deduction. Vehicles, if you have vehicles you use for business, obviously anything related to those would be deductible. If you have a home office, you're working out of your home, deductible expenses. Any rental spaces you might be doing as well. Accounting and bookkeeping fees or software. Next slide, please. All right. All your professional fees, legal fees, tax prep, consultants, obviously utilities, rent, insurance, employee benefits and wages, any supplies, any expenses incurred to generate sales, like marketing, advertising, conferences and networking, even continuing education. For those of us in the accounting profession, we are required to do a lot of continuing professional education to keep our licenses. And so that's all tax deductible. So if you have any of that, that would be tax deductible. If you have training you know that you need to take in order to stay relevant in your industry, tax deductible. So, next slide, please. All right, so as I mentioned, here we are, it's the end of October, it's almost Halloween, we're coming up on Thanksgiving and the big holiday season. We're almost at the end of 2025. And so, my question for you to think about is, what does your income look like right now in 2025? Where do you think 2025 is going to land? And what does 2026 going to look like? Because as we talk about last minute year-end tax tips, we also want to kind of keep not only 2025 in focus, we want to be thinking about 2026. So that way there, not only do you end 2025 really good, you set yourself up for a good 2026 as well. So one of the first things we want to look at is maximizing our business deductions. Do you have any planned purchases? Maybe you've got some old computer equipment or some old tooling that you might need to replace, and looking at well, maybe I'll do that next year. Consider bringing that in this year if you can do it, especially if you think you're going to have good income this year, maybe not so much next year. Bring those expenses in and make those purchases before December 31st. Don't forget common deductions. My self-employed people especially, sometimes I'm not real good about tracking this, but try to track your vehicle mileage so you get your vehicle deductions, insurance premiums, again, those professional development costs we talked about earlier. If you know you have a training class that you need to do or you've been looking to do to improve your skills so you can continue to keep your business going and be relevant, get it done. Get those things done. On this other token that I talked about looking at the next year, if 2025 is not looking so good, 2026 is looking like it's going to be much better, you may want to consider doing the inverse and deferring some of these things. Again, that's where talking to your tax advisor becomes really important, where we come in having your books kept really good, keeping good records. We can look at your records, see where you're at. We can have a conversation about where you see things are heading, and we can make it a plan that's appropriate for this. Next slide, please. So another couple more last minute and year end. If you can implement some income deferral techniques. So if you have stuff that's you're finishing up really late in the year, and I'm assuming most of you are going to be cash basis, invoice it in January. If you are delivering a product or service, see if the client can wait until the beginning of January to get that client or service. This income deferral techniques are a little harder to pull off for some industries, but if you have that flexibility or you think you might, take a look and see. Those are good ways to keep your income down this year and pushed into next year. Especially if you're not sure what next year is going to be, if you're more concerned that next year might not be as good as 2025, might be a good thing to do. Next slide, please. All right, this is really a good one. If you haven't already, consider starting a retirement plan. Some plans need to be established by the end of the year. Like your simplified employee pension plan SEPs, those need to be established by the end of the year. You don't have to fund them. You have until April 15th to fund, but you really would, so that kind of retirement plan and other employee type of retirement plans will need to be done by December 31st. Those plans do cost some money to set up. And that's where those tax credits come into place. There may be tax credits available to offset those costs. So talking to your tax advisor to see if this is a good idea for your situation and how best to maybe utilize some of those tax credits that might be available. In the meantime, plan on maximizing your retirement account contributions. If you don't have at least an IRA set up someplace, good idea to do so. That's a great way to kind of help bring down some of your taxable income and put some money aside for the future. Next slide. All right. Charitable contributions before December 31st. If you are looking to make some charitable contributions, it'd be good to make them before December 31st. In order to take advantage of a few things that are going on. This is going to get a little bit into the weeds. So I'm going to ask you to kind of hang in there with me because there's actually a lot going on with charitable contributions. And I think it's important to listen to understand what's happening. So one of the great ways you can actually make a charitable contribution before the end of the year is to donate an appreciated asset. So I know a lot of people might want to want to make a donation to an organization. They want to do it before the end of the year, and they might say, "Well, I need some cash to do that." And so they'll go and sell maybe an appreciated asset, a stock that they've had for a while. They're looking to rebalance their portfolio. They've got too much of something, so they're going to sell it, and then they're going to donate the cash. The problem is, as soon as you do that transaction, you incur capital gains. A different option would be to donate the appreciated stock directly to the organization, assuming they can take those type of contributions. The great part about this is not only you rebalancing your portfolio like you want to do, but you get the tax deduction at fair market value of that appreciated stock, and you avoid the capital gains tax. So you get to do a great thing, you avoid capital gains, and you get a great tax deduction for doing something good. Another strategy that you could do is what we call bunching of donations. So you may have, maybe you had a good year, you got a windfall, you want to make a bunch of, a big donation, or you're making a bunch of donations every year, you do a consistent amount. One of the things you can do is you can take all those donations that you would make over, say, the next 3 years and bunch them into one and do it all at once. Especially with the changes coming and the SALT deductions and the, sorry, I need my glasses to look at my notes. Apologize. Had this on the top of my head 2 days ago. Donation floor that comes into play in 2026. So bunching donations, because of the SALT changes, if you are up to $500,000, the SALT cap, that's the state and local tax cap that was capped at $10,000, goes up to $40,000. So now itemizing becomes better. And if you can get that all done like this year, say you were going to donate, $20,000 of donations, you had $10,000 of state and local tax deductions and $15,000 of mortgage interest, that gives you $45,000 of itemized deductions, which is great. But if you were to bunch your donations and say you did 3 years worth of those donating, that donation amount, that $20,000 becomes 60, 3 times 20, 60,000. Yeah, $10,000 still of your state and local tax deductions, 15,000 of mortgage interest deductions. Now your itemized deductions goes up to $85,000. So you get a better tax benefit by bunching. The other thing that can happen with the donations to keep in mind is starting in 2026, there is a donation floor that you're going to be subject to. So if you itemize, the first 0.5% of your adjusted gross income is not eligible for donation. So how does that work? Not for the deduction. Your AGI is $200,000. 0.5% of that would be $1,000. Normally, you say you donate to your charity $10,000 every year. You would think you would take a $10,000 deduction, but because of that $1,000 floor that's on that 0.5% of that 200,000 AGI, you're now only eligible to take a $9,000 deduction. That starts in 2026. So if you were considering donating over the next couple of years to an organization, bunching in 2025 not only gives you a better tax deduction, but you will avoid that floor. One of the great ways of doing bunching and to process these is to use a donor advised fund. So donor advised funds you would set up with your financial advisor. You can put all the cash there. And the nice thing about that is you can then later tell them where you want that donation to go, and they can then direct it. So charitable contributions are getting very complicated. And if you are someone who does do a fair amount of donating, really talk to your tax advisor about how to strategize to take advantage of these, best advantage of your deduction, because it's a very much a changing landscape here. Another way you can save some money, if you're at an age where you are required to take required minimum distributions, RMDs, from your retirement account, you can use the qualified charitable distributions to satisfy your RMDs. So that's another way to make sure you satisfy your RMD and you're able to donate some money. Next slide. All right, a couple more. One of the things we like to do is review and adjust your estimated tax payments and tax withholdings. I have a bunch of clients that I usually like to talk to, at least mid-year, and I'll talk to again at year end just to see where they are. Some people have very variable income, especially, so take that pulse. And so we can make sure that we're using safe harbor rules to avoid underpayment penalties, that you don't miss any key payment deadlines. So some of these deadlines are going to be, some states will tell you can go to January 15th, others going to December 15th or 31st. We recommend making all state estimated tax payments by December 31st, as you may be able to deduct it on your current year federal return if you itemize. Again, talk to your tax advisor, get a strategy in place, and then also make sure you're not underpaid, because sometimes those underpayment penalties, they can hurt. They can sting. So next slide. All right, and so benefits of year-end consultation. Again, avoiding penalties, maximizing your deductions, strategizing for not only the current year but the next year, to make sure that you are, as tax rules are changing, that you're taking advantage of the tax rules and you're not getting hit with something you didn't expect. Like, I didn't know that was coming. If I had known, I would have planned, right? So we can help with that through a year-end consultation. Again, that strategy planning for the next year, talking to you at year-end is great, and planning for the current year is great, but the world's not stopping tomorrow, so we need to continue to think about what your next year is going to look like. And I encourage people to keep a warm relationship with their tax advisor, because I'd much rather take a call from you in May or June with, hey, I'm thinking about, or what would happen if we know what things are happening, we can help you plan for that future better. So, and next slide. All right, and that's it. I think there are some questions. I'll take a
peek. Yeah, first question that's in the chat is from Mauricio. Can you speak about the new SALT deduction limit and how that connects with bunching charitable contributions before year end?
So the new SALT limit is if you're under $500,000 of AGI or under, or income under taxable income, your SALT limit goes up to 40,000. So you're no longer limited at 10, and then it phases out eventually fully at 600,000 of income. So depending on how much you're donating, because you no longer, you no longer have that salt limit for certain items, and you can makes itemizing easier. Bunching just as a way to basically leverage more tax deductions at the end of the day for the current year. I'm not sure if that's really answering the
Your
question well.
question, Mauricio? You can unmute yourself and ask if you want.
Oh yeah, thank you for the mention here. But because you're gonna have these restrictions on charitable contributions with a half a percentage of AGI that is a floor. If
Yep.
you wouldn't itemize before, but now you would itemize because of the higher salt deduction, and then uh, bunching the charitable donations this year to avoid that floor and
Right.
yeah, benefit from it.
Yes, that's exactly. If you bunch them this year, you avoid that floor next year.
Yeah, thank you.
Then, is there anybody else have any questions or anything? If not, I had a silly one on the professional development classes. If you do you take the if you take the deduction when you pay for it or when you take the class?
When you pay for it. Well,
Okay,
let me clarify. If you're cash basis,
yeah,
it's usually when you pay for something, right?
okay.
Cash basis. I don't think if anyone's on an accrual basis, that's a different thing. But generally, yeah, cash basis, you take it. I mean, mostly if you're taking a class, you're probably not going too far out in the future. So I'm not going to be, from a tax perspective, I'm not going to be panicking about it unless I think it's something that should be prepaid. But generally, classes are taken pretty contemporaneously from payment.
James, you have a question?
Yes, thank you. So, just to clarify that, actually two questions. One, if I am doing a non-certificate, it's professional classes, but it's non-certificate in the sense it's at a university, and I know I have spring classes that are coming up, and I have the ability to pay for all of the classes in December, and I am on a cash basis. Just want to make sure I'm understanding that that's an example of being able to deduct something by paying for it in the current tax cycle, tax year, by paying for it a little bit earlier. It's not due until January, but it's notable because I pay for all my classes up front for the semester.
Will the classes all be taken in less than 12 months?
Yes, that is correct. I can't sit for the certification until I complete the classes, and it's winter and spring, if I'm not mistaken.
Yeah, I think you're probably fine.
Thank you. Thank you. And then the other side of it is um talking about I apologize, the bunching again. Does that mean that I have to allocate? So just real example, right? Like, so lots of profit in the market.
Yeah.
And so on a nonprofit, as a board member, going to donate there anyway. I'm trying to figure out, like, do I need to basically do all of 26, 7, and 8 if I want to take advantage of that? That has to be realized in 25, or do I just do a direct share contribution to the board, right? So I'm not touching it as cash. I'm literally transferring those equities.
Appreciated asset. Yeah, I would recommend talking to a financial planner at the same time, but they can set up a vehicle where if you do the donor assisted words, words. I hate words sometimes.
That's okay. It's lunchtime. My sugar's low, so I'm guilty of it.
I'm with you. Yeah, a donor advised fund. So you can, the thing about a donor advised funds, you can make all the donations in there. You can do your bunching there, and then you can determine afterwards with the financial advisor where those funds are going to go. And you don't have to release them all at once. you can release them over the course of a number of years. That's one of the beauties of it, is that that's where it helps with the bunching, is that you can put it all there, and then you can decide later who gets it and when, and
Got
they
it.
get to appreciate while they're there.
James, here, Marcy again. I'm a financial advisor, and I help clients all the time do that kind of transaction year end with donating appreciated stock. As Lisa said, donor advised fund is a popular way to do it, and you can donate a lot this year and then disperse later to the nonprofit. However, if you want to have a more immediate impact on the nonprofit, you could donate in kind to the nonprofit, provided that nonprofit has a brokerage account. I happen to also be in the board of a nonprofit, and we recently opened a brokerage account with Fidelity, and we'll be soliciting donations of appreciated stock this year. This is very good for the individual or family willing to support a cause, and very tax efficient, and the nonprofit benefits directly. Now, the nonprofit must have a brokerage account. So if your nonprofit doesn't have one, you should work with a brokerage you trust, with a financial advisor you trust, and open an account to facilitate the process.
Thank you.
James, I can connect you with Mauricio offline to have that conversation a little deeper. If you guys want.
It has to be in kind. That's very important. And also, it needs to happen earlier, sooner rather than later, because towards the end of the year, a lot of times brokers and custodians struggle to process that. If it's last minute, you may not make the cutoff to the end of the year. So just be careful.
Thank you.
Any other questions or comments from anybody? We got time. Kind of trying to scan for hands. Or she did such a great job explaining it. Nobody has any questions. Lisa,
I have a question for Lisa. It's about IRS and the frequency of audits, given all the IRS layoffs. So what your firm is seeing in terms of audits, given the current staffing at the IRS?
I actually I don't really have any insight onto that at all. I really personally haven't had any clients go get audited. So it's interesting times. I think so a lot of it's going to be a wait and see.
All right, thanks.
We have another question in the chat. Is the QBID extended, and can you speak on that? And maybe Tammy, if you want to unmute, maybe ask the question.
Yeah, I think it was a 2018 bill that expired in 25, and was wondering if that was going to be extended. I think it was like a 20% qualified business income deduction that was passed through for S-corp businesses.
Yeah.
I think the 199A deduction is what she's asking about. Does that sound right,
Yeah.
Tammy?
I'm not sure.
Yeah, it is. I don't know off the top of my head. I believe it has been. But that's something we can check, and I can get back to you.
Okay, thank
For those of us that are lost, what is the 199A, or what are you referring to?
It's the qualified business income deduction. So certain specified businesses are allowed a 20% deduction just off the top of their income.
Nice.
Yeah. So it was set to expire. Actually, Bahar, thank you so much. Bahar from one of my co-workers at Matthews Carter and Boyce says, yes, it is permanent now. I thought it was.
So that's now a permanent deduction that those businesses can take.
Yep.
And what type of businesses like really benefited from that, I guess? Now I'm really,
They're usually specialized services. Oh, God, I use it all the time. Um, but definitions, right? Yeah, so there's a listing that they have of businesses that qualify for it.
so it might be definitely something to ask your preparer if you, to see if you qualify, because it's pretty large deduction.
Yeah, I'd be surprised if the preparer is not picking it up if they do qualify. But oh, thank you, Sarah. She just sent out a link to
Oh,
it.
there you
Yeah.
go.
Yeah, I know in my business as a financial advisor, if you make more than a certain income threshold, you're not able to deduct. So depending on if you have specialized businesses, there's a list of businesses. A lot of it in professional services,
Yeah.
you have limitations of how much you can deduct. But generally, if not specialized, it's 20% of pass-through income, like S corporations and partnerships and so proprietorships, entities like that.
Awesome. Almost lost me because my laptop almost died. That'd be bad. Any other questions from anybody or comments? And I will say we are going to be sharing the deck with you guys after the fact. So we will be sending that out to all the attendees. So if you do, it does have Lisa's contact information. So if you do have questions that come to you after the fact, which sometimes happens, you can certainly reach out. And I'm sure she'll be more than happy to help you out and direct you in any way that she can. So is there anybody else with any questions or comments? Some thank yous coming in, I think. All right. Well, if there aren't any other questions, we'll kind of wrap this up and give you guys some time back. I want to thank everybody for coming today. As I mentioned, we'll be sending out the deck for you to review. And we'd like to encourage you to join us for other chamber events that are coming up. We've got our breakfast connection that's coming up with the Alexandria Chamber of Commerce at the Crystal City Sports Pub on November the 13th. I will say this generally sells out. So if you are interested in that, definitely register sooner than later because we do have a hard cap on that because of our capacity at the sports pub. Our business after business this month is going to, well, actually, it's next month. It's going to be at Punch Bowl Social on the 19th. Our next Small Business Roundtable will be also on the 19th. It's being a queer celebrity, a business owner to your employees and clients. Complete list of chamber events. Always, you can look at our website at arlingtonchamber.org, and you can check out those events there. And I'd like to also obviously thank again our small business premier sponsor Supporting Strategies. It's with their help that we're able to make these events possible and also free for our membership. So a big thank you to them for their support throughout the year for that. And we did put the link to the chamber calendar in the chat if you want to pull that up. And we've got the room for a few more minutes. So enjoy the rest of your day.
Thank you, guys.
Thanks,
See ya.
Will. Thanks, Lisa.
Thank you, Lisa. Great job.
Thanks.
Yeah. All right. Thank you all and have a great day.